The iron butterfly, similar to an iron condor where it's a combination of two strategies, the iron butterfly is the same. Some people look at it as a combination of a call credit spread and a put credit spread. So selling a bear call spread, selling a bull put spread. I like to look at it as a difference in straddles and strangles. A short straddle is where you sell a call and sell a put of the same strike and same expiration. A strangle is where you're, in this case, a long strangle. You're buying a call and you're buying a put of different strikes, but you're buying both options, same expiration. Either way that you look at it, whether it's a combination of the credit spreads or a short straddle and a long strangle, you still have that same objective of the range-bound trading. You want the stock to trade within a narrow range. And because your objective is for everything to expire worthless. When we sell options, we want to keep 100% of that premium, and the way to do that is for all options to expire unexercised, unassigned, and without value. So here's an example that we've got 28 days to expiration, stock trading 87.5. Our expected price range is $85 to $90. That's where we think the shares are going to end up at expiration. So what we can do is the straddle in the middle of our range, 85 and 90, 87.5. That's going to be our middle point. We can sell the $87.5 straddle, and we could collect $6.90 for it, almost $7. It's because we're selling an at-the-money call and we're selling an at-the-money put. That's typically how straddles work, at-the-money options. For protection, again, because we're not always right, for protection, we are going to purchase a strangle. So if you were to look at a straddle, the profit and loss on a straddle is like an upside-down V. The center point, the top point, that's going to be the at-the-money. That's the at-the-money strike. But there's no protection to the upside. There's no protection to the downside. We don't like that. We don't like no protection. So we're going to buy a strangle to turn those endpoints kind of out. So we're going to buy the $80 strangle, $80.95 strangle. It's going to cost us $1.80. We're going to give back some of that premium for protection. $5.10 is going to be our net credit on the trade. That's, again, going to be our maximum profit, our maximum gain. Our maximum risk is going to be $2.40. Break-even points, 82.40 on the downside, 92.60 on the upside. Very similar to like an iron condor. You take your short option and you're going to add or subtract the premium that you collected on the trade to figure out your break-even points. And here is what our profit and loss looks like. Again, we've got that 87.5, that's where stock is trading. This is our at-the-money straddle, the upside-down V there. And here's our protection. So if shares finish below 80, we've got protection to the downside. This is where that strangle kicks in. The long put on the strangle, the long call on the strangle here if shares finish over 95. Those long options are added for our protection. So in case we are wrong, we've got some built-in protection. If shares finish at 87.5, we would expect all legs to expire unexercised and without value. In this case, we would retain 100% of that premium that we collected. That $5.10, it's in our pocket and it stays there. If shares finish between our strikes, our long strikes of 80 and 95, one of those short legs is going to be in the money, and it's likely going to be assigned. That would then correspond to either a long or short stock position. Our break-even point, or our profit or loss is then going to be determined by where we liquidate that stock. If we're short stock, where do we buy it back? If we're long stock, where do we sell it? It's all going to depend on that liquidation point. If shares finish between our strikes of 80 and 87.5 on the put side, or 87.5 and 95 on the call side, one of those legs is likely to be assigned. Again, we've got a long or stock position, and our profit and loss is going to be determined by where we get out of that stock. So an iron butterfly combination of for me, it's easier to understand it as a combination short straddle, long strangle. You could also look at it as a combination of a bear call spread and a bull put spread, with the short strikes being the same of the bear call spread and the bull put spread. That's an iron butterfly.